Apax Partners investment in Cholamandalam. Well, we've got with us Shashank Singh, who is the partner and head of India at Apax Partners, and he's joining in for a quick chat here on Smart Markets. Mr. Singh, good evening, and thank you so much for taking time out for us. My first obvious question, are PE players like yourselves rushing to the exits given the record run that we've seen for the bourses?
It was a strong year for the capital markets. Obviously, the IPO markets were strong, public markets were strong, hitting all-time highs, and that made for a very conducive environment for exits. It was an opportunity that a lot of private equity funds took.
Let's talk about something closer to home. You've recently exited Cholamandalam Financial Services. Walk us through, the transaction details on that one.
So it's a fantastic company. We were partnered with the management team and with the Murugappa Group for nearly 3 years as part of that investment. Company performed extremely well as part of, in fact, ahead of the rest of the NBFC and the financial services sector. And so late last year, we took the decision that over a period of time we would exit the transaction. And the strength of the public markets was one of the enabling factors towards that exit, and so that investment was exited between September of 2016 and January of 2017.
Talk to us a little bit about the kind of returns that you've made on your investment. It is, after all, the top 5 exits that we've seen this year.
Sure. So the total exit proceeds that we got were roughly $250 million. And it was a return of approximately 2.5 times money in a period of about 2.5 to 3 years.
Okay, let's talk about market valuations then. You were talking about how things are looking good, especially for the IPO market, not just the primary market, the secondary market as well. But would you say that things have run up a little too quickly? And is it looking expensive even for private equity investors now to, look at these levels and rationalize them?
From a new deal perspective, I would say one has to pick one's spots. I think if you just buy the overall index, it would come across as expensive. The PE multiple for the index is pretty high at the moment. High growth companies within that are trading at even higher multiples. And so one has to have a very clear thesis. I think this is probably one of the reasons why new deals have actually come down in FY16-17 versus the prior year, whereas exits are up.
But there's also a wave of consolidation and M&A that, we've seen, especially in the listed space. Is that an area where, PE firms are keen on participating, not just Apax, but, what would you say of the industry?
I think selectively perhaps, but again, back to the point I made on valuations, any PE fund looking to enter this kind of transaction would have to have a very clear thesis as to how it's going to make money from a private equity perspective, not a public market perspective, in a transaction like that. So if you're taking over a company, it would have to be a thesis around a change, perhaps a change in management, perhaps a change in the trajectory of the company, profitability, and so on. You have to have a clear plan around active management of the company. At those valuations, also paying a takeover premium, a strategic premium, I think people would find it challenging to make returns if it was just participating in a public market takeover trade.
Okay, let's talk about some of the sectors that are looking good to you right now. In the past, of course, you've bet on NBFCs as well as IT. Will you continue to back those bets? So
far, our sectors that we've invested across India over the last 10 years have been practically across all of the Apax sectors. 3 companies in the technology services or IT services BPO space, 2 in the financial services space, specifically NBFCs, and 1 healthcare in the hospital space. We continue to remain active across all of the sectors. I think different companies, different sectors go through different cycles over time. Some of these sectors are very expensive. Consumer, as an example, right now, very expensive. healthcare services or hospitals also quite expensive. But on the other hand, there are parts of healthcare like pharmaceuticals or IT services that are much cheaper at the moment. We continue to look at investments across all of our sectors, but opportunistically, depending on the risk-return trade-off, some sectors are more favored than others at different points in time.
You talked about how valuations in IT and pharma are actually not looking so bad. So would you then say that it is a good time maybe to buy into IT given, you know, the moderation in valuations, or at this time it's perhaps a little uncertain because of, you know, say where the rupee is going, or even the overhang of the visa uncertainty that's keeping investors at bay?
I think it's, yes, I agree with that. I think people are more cautious right now. And I don't think it's restricted to just the H1B issue. The rupee is strengthening. That is a bit of a drag, although that can be short term. There are regulatory concerns around immigration policies and visa policies. But more important than all of this is that the market itself seems to be changing. Particularly the shift to digital has meant that a lot of companies have been caught short. Those that were quite comfortable operating under the old labor arbitrage model without a proper offering to clients around where the spend was going, how to future-proof their clients' IT infrastructure and so on. I think that in itself is proving a headwind for the industry. There are pockets of that are growing fast, but there are large parts of the market that are struggling. And so you've got to figure out which company is sort of winning in the right space around that shift.
Right. And before we wrap things up, are you hopeful that this year we'll see larger buyouts and, you know, check sizes being cut out, given that last year the Indian PE industry actually did see a drop in deal values?
I do believe so. I think if we were to again rewind to 2007, which is when Apax set up in India, buyouts was about 5% by value of the total private equity market. It's already up at 20 to 25%. So if the 10-year trend, and I'm a fan of history and a student of history, the 10-year trend is towards a significant increase in the proportion of buyouts. And I believe that if again you were to fast forward over 10 years, and we really should look at private equity over that kind of time frame, then we will see buyouts as a much bigger proportion. So yes, the answer to your question is I do believe that large checks, buyouts, controlled transactions will be a much more significant feature of the private equity market than they have been in the past.
All right, on that optimistic note, we'll say thank you. Mr. Singh, thanks so much for taking time out for us. Thanks.
My pleasure. Thank you for having me.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.